Well, welcome to lesson 37, accepting risk, as my cat rubs his face on my laptop. How are we doing today? We're going to be talking about accepting risk today. Okay, I know, this is the risk of having a cat that likes to be in videos. We're going to be talking about accepting the risk today, and then wrapping a pretty bow on mental analysis today. So, we have some great topics today. We're going to finish up risk management and finish up mental analysis, put a pretty bow on that bad boy, get more than half our structure done. It only took me few months and some change, so we're finally starting to get there. Today we're going to discuss the 5 steps I have of identifying, analyzing, evaluating. We're also talking about treating and adapting to, and then monitoring risk. These are the 5 things I want to mention because, again, until you can fully accept risk, you'll never be as good as you could possibly be. And so these 5 steps are going to be very keen and important to you in actually accepting the risk, modifying risk as it goes along, and making changes. So again, first, identifying risk with technical analysis, with fundamental analysis. Well, how do we identify risk and say this is what I'm risking to make A, B, or C? Can I change it later? What are we going to do pre-market, during, and post-market with risk? How do I properly identify risk? That's going to be first. Second's going to be analyzing risk. Once we have that risk identified, right? How do we analyze it and get proper risk management, proper risk versus reward, and avoiding FOMO and boredom trades? One of the biggest problems with beginners is they think this is a job and they have to do something every single day. You don't. And sometimes the beginners identify a risk, analyze it, and then go for it, when in reality, they probably should have done nothing because they had FOMO on the one runner of the day, or they had boredom because nothing's happening that day. We'll discuss both those as well today, here, now. We'll also discuss evaluating the risk once it's taken on. What's that risk? What's that reward? Can you explain the risk to a 10-year-old? If your little nephew asks you, what's the risk of this? You can say, well, buddy, A, B, and C. That's what it is, right? Do you weigh this risk against opportunity costs of other trades that are better or worse? That will also be discussed as well today. Fourthly, we're going to discuss how to treat and adapt to risk. Once you're in a trade, what do you do? How do you have no mental stops? How do you have patience? How do you have impatience? How do you adapt once this trade takes off? What are some steps you can take to monitor? Again, we're going to discuss this one more in depth later, but I'm going to discuss this today briefly. And then fifth, how do you monitor the risk once you're in as well, and how do you get out? How does adding to a loser a terrible idea? How is cutting a winner too early a terrible idea? What do the best winners do, and how do they admit that when they're wrong? We'll discuss that as well. Lastly, we'll have a nice little outcome of what we've been discussing, and then wrap this bad boy up. Again, should hopefully be a pretty quick lesson, but I think this is super important to talk about when it comes to accepting risk fully, and then moving on to lesson 38, which are the 4 indexes that I use, and then move on to how to hold a stock. Some great stuff coming up. With that being said, lesson 37, accepting the risk, and wrapping a pretty bow on this. Let's get into it. So when it comes to the 5 steps, I have 5 things I do to identify risk to fully accept and act upon risk. 1 is identify, 2 is analyze, 3 is evaluate, 4 is treat or adapt to the risk, and 5 is monitor. These are the 5 things that I do when I accept risk and take on risk. The first being identifying the risk. My first step in identifying risk and accepting risk is keep it simple, stupid. That easy. From what I've talked about, modify what you like, change what you like, the time frame, whatever it is. The amount of risk you're willing to take on is different than mine. I almost guarantee it. But keep it simple, stupid. Step 1, identify predefined risk. Weigh that against the reward. It's all you have to do. You should have only 2 outcomes when you enter a trade: stop loss or price target. Sure, the price target side, you may go up way more if it runs off, but you identify the risk by keeping it simple, saying I want to stop out at 2%, 3%, by technicals, by the fundamentals. It's up to you. You identify the risk simply. You then accept it by saying I'll hit the stop loss or the price target, and then you act upon it. To further identifying risk, it's a very simple idea, but the further add to this, I think the biggest mistake beginners make is this: they do their research, they do their work during the trading day. No more. Most successful swing traders, and this is different for day traders, but most successful swing traders, long-term investors, all their research happens after hours or pre-market for most day traders, honestly. Anyone who is doing their research on a green day trying to catch a runner, you're goofing up fully. I think most successful ways to identify risk happen after hours. You have time to chart, time to research, time to set price targets and stop losses, make a whole plan the trade the plan after hours or pre-market for day traders, and you act upon those. That's how you identify the risk fully and accept it simply and not overcomplicating it. That's how I identify risk. Keep it simple, price target, stop loss, research after hours. That's simple. When it comes to analyzing risk, my number one goal is to stop emotion. That's what I'm looking for. As I analyze risk, as I say, I've identified the risk, it's 1, 2, 4, 10%. How do I analyze this to make this a non-emotional trade? Again, first step, you only have a price target or a stop loss. You hit one of those, you are out. Only two clear outcomes, A or B. No C, D, E, F, G, none of that kind of stuff. You have A and B and that's it. That's how you take out emotion in the analyzing risk phase in itself. If you can identify the most amount of risk you are taking on, that's the first step to fully accepting it, and you can then change if serious reasons need to be changed. If you don't have a risk stop loss area, let's say it just plummets on you, like after hours drops 30%, now you gotta make a new plan. Let's say it takes off 30%, now you gotta make a new plan. You cannot adapt to it, which is later on, you can't adapt to the risk if you don't have a set plan and have the risk analyzed to begin with. So again, strong stop loss that stops emotion trading, which leads in the second point of analyzing risk. You do not play FOMO, you do not play boredom. It's hard to do for beginners, but it's so true. As we discussed with the employee mindset, the small business mindset, investor mindset, the right column, investor mindset, is way different than employee mindset. There will be days where there are no trades. Welcome. There'll be trades where you don't do anything, or there'll be days, maybe weeks, where nothing presents itself, and what you can do instead of FOMOing into a dumb play or playing boredom because you're bored, or focus on other things. The analyzing risk stage can include, and I do include, other skills and working other skills. If you want to just sit in front of your computer like this, there's nothing to do. Instead of doing scanning, instead of doing technical analysis, instead of reading fundamentals, researching blue chip companies, trying to find the next big one, there's so much you're giving up by playing FOMO and playing into boredom. When it comes to analyzing risk, broader sense of it outside of just individual tickers, if you're gonna say, I'm gonna waste my time looking at nothing when there's so much more resources to be had and so much more to learn from, you need to identify that risk early of wasting your time and being efficient. Go search for other scanners, go to Reddit, check out what they got going, go to FinTwit, go on CNBC Finance, I don't care. But if you have nothing to do all day, don't FOMO, don't get bored. And again, analyzing risk comes down to stopping emotional trading, which starts with FOMO and boredom. After that, we have the idea of evaluating the risk. So we've identified it, we've analyzed it, now how do we evaluate it? First, risk versus reward. This is important because you want to say the risk is 5%. You better be able to make more than 5%, if not 15%. 3 to 1 is usually my bar minimum. If I can't make 3 to 1, I don't want to get into it. Because if I can make 3 to 1, if I win more than 3% of my trades, I'm green. That's pretty good. That's really a hard bar to lose in a bull market. You can usually get 50% at worst usually. With that addition, can you explain the risk to a 10-year-old? It may sound stupid, but it's very true. In the heart and sense and faith of keeping it simple, stupid. If a 10-year-old asks you, hey, if you buy this, what's the risk? And you have to explain a whole bunch of different scenarios, you're not doing it right. If you can explain the risk to a 10-year-old, like, see, this is a $10 stock, Timmy. If it dips to $9.50, I'm gonna lose my money. That's it, right? If you can explain to a 10-year-old the risk and reward you're taking on, you're doing it correctly. If you have to do a whole bunch of contingency plans and like, well, if it does this, I'm gonna do that, and then if it does that, I'm gonna do this. That's what we're gonna do. Very confusing, don't do that. Especially if you're a beginner, keep it simple, stupid. Explain it to a 10-year-old, and if you can, you're fine. Thirdly, with evaluating the risk is opportunity cost. If you can say this stock here has a risk of 5%, I can make 15%. Is there a better spot for your money? Possibly. If you can say this is gonna make 20%, only risking 2%, would you rather take that trade instead? Probably. So make sure when it comes to identifying, analyzing, then evaluating the risk, you can then take that risk versus reward margin and put it against any other trade in the market. Because if something else has a better or promising risk versus reward,